already begun. Two words from Finance Minister Nirmala Sitharaman, and they might just redraw India's banking map. What's the goal? A lot of world-class banks. So what happens to your PSU bank stocks when consolidation stops being a headline and turns into a blueprint? For the first time in 14 years, India's state-owned public sector banks, the PSBs, have outpaced private banks in loan growth, 13.1% in FY25 versus 9%, and posting a record net profit of 1.78 lakh crore rupees. It's a sharp reversal of the last decade when you had private lenders grabbing market share while, the PSBs were battling bad loans. Today, the balance sheets are clean, more cleaner than they've been in years, with net NPAs at just 0.52% as of March this year in 2025. But here's the truly striking factor. Despite this performance, PSBs still trade at a discount, averaging 1.26 times the book value compared to private sector peers at twice the book value. The government, they're now seeing this timing as perfect, setting up the next consolidation wave to create fewer, stronger institutions for India's growth push. Now, let's stack the catalyst. You have record profits, cleaner balance sheets, and a potentially game-changing policy shift. That combination screams one thing: the next massive re-rating opportunity. Welcome to Bottom Line by Groww. In today's episode, we're going to be looking into the PSB story, from years of stress to that sharp turnaround, why consolidation talk has put these banks back in focus, and more importantly, what this could mean for you. But to understand where we're really going, we must appreciate the journey. Just 6 years ago, PSBs were saddled with bad loans. It was dependent on taxpayer recapitalization and widely viewed as high-risk investments. At the crisis era peak, we're looking at March 2018, the average gross non-performing asset for PSBs soared to 14.6%. Now, the turning point came with the RBI's asset quality review, what is known as the AQR, and the government's 4R strategy. 4R: recognition, resolution, recapitalization, and reforms. Now, together, they forced the banks to address hidden stress by mandating transparent NPA recognition and setting up the stage for a genuine balance sheet cleanup. Let's look at the numbers today. One record profit. Collectively, the 12 public sector banks posted a record 1.78 lakh crore rupees net profit in FY25. And that's a massive 26% jump year on year. And just for context, PSBs now contribute roughly 48% of total banking sector profit. 48%. Two, the cleanest balance sheets in a decade. Now, the sector's asset quality is at the healthiest in over a decade. Now, the gross NPA ratio has collapsed from a peak of 14.6% in FY18 to just 2.8% in FY25, while the net NPAs have shrunk to 0.6%, converging with private peers, which is an really extraordinary swing from the double-digit net NPA just a few years ago. At the same time, provision coverage has surged from 45% in FY18 to 79% in FY25, meaning the losses far better cushioned. 3. Capital strength. Public sector banks are now much better capitalized. Now, the core equity, which is often called the CET1. Now, this comprises common equity and disclosed reserves that absorb losses first, and it's expressed as a share of risk-weighted assets, and that has climbed from 9.4 to 11.8% in FY20 to 11 to 15.3% by first quarter FY26. Meanwhile, the capital to risk-weighted assets ratio, it's called the CRAR, which measures a bank's total regulatory capital relative to the riskiness of the assets. Now, think of this as the bank's shock absorber. The higher the CRAR, the more the capacity to absorb losses and still go on lending. With PSBs now in a healthy 15 to 18% band, they sit well above the regulatory minimums, signaling strong resilience to stress and greater headroom to fund growth without really immediately tapping external capital. And crucially, the mix has changed. Now, after the 4R era, government infusions leading PSBs such as SBI, PNB, Canara and Union Bank have been able to tap markets via QIPs and other raises, signaling self-sustaining balance sheets rather than dependence on the exchequer. Now, most now also carry a public float about 25%, underscoring improved market confidence along with capital strength as well. All this turnaround has led to a direct impact on the stock market. Over the past 5 years, the Nifty PSU Bank has compounded at about 46.8% a year, massively ahead of both the Nifty private banks at 16.9% and the broader Nifty Bank at 20.2%. Now, in the past 1 year alone, the Nifty PSU Bank index is up at about 21%. That's handily beating Nifty Bank at 12% and the Nifty 50 at 6%, and a clear breakout while the broader market lagged. And that market outperformance, it didn't happen in a vacuum. A big tailwind was the consolidation wave of 2017 to 2020, which streamlined the PSU landscape, taking it from 27 banks to just 12. Now, reviewing the two major phases of consolidation between 2017 and 2020, this provides crucial insights into how future mergers will unfold and what they can deliver. Now, the first phase occurred in 2017 when State Bank of India, SBI, absorbed its 5 associate banks and the Bharatiya Mahila Bank. This move instantly boosted SBI's balance sheets by about 36%, making it one of the world's 50 largest banks. In the immediate short term, SBI experienced an integration slog and they reported a record loss of 6,547 crore rupees in FY18 as bad loans provision surged and its gross NPA ratio stood at 10.91% at FY18 year-end. However, within 2 years, SBI successfully integrated all the operations and benefit it became tangible. Now, this pattern of J-curve is visible in SBI's share price chart as well, where 2 years of post-merger gave flat returns, and that was followed by a sustained upswing as synergies kicked in and the profitability strengthened. Now, arguably, SBI's successful integration, you can say, set the stage for the broader PSU bank merger plan that followed. Now, the second phase was a couple of years after that, in the 2019, the mega merger plan, which became effective in April 2020, reducing 10 public sector banks into 4 very large entities. Now, despite a short-term merger-related uptick in customer complaints during IT and process alignment, this spike was temporary. As integrations got completed, the benefits emerged clearly with record multi-decade low NPAs and profits. Once again, the lessons from both rounds display the J-curve, where the anchor bank stocks did not immediately reward shareholders, but those who maintained their positions saw substantial gains and benefits of scale and the efficiency that materialized, 1 to 3 years later. Now, coming to the present, the competitive dynamic between public sector banks and private banks has, it's undergone a significant transformation since 2020. And a key development is the convergence of asset quality. Now, historically, the difference was massive. At the peak, the PSB private gap in gross NPA was 9.8 percentage points. Today, that gap is down to 1 percentage point. Crucially, the net NPA ratio for both ownership categories is highly comparable, hovering at around 0.6 to 0.5% as of March this year in 2025. This convergence means that credit risk is no longer the key distinguishing factor for investors that it was a decade ago. And this cleanup has led to a massive profitability lift for public sector banks. Return on assets for many PSBs is now approaching 1.1%, which was once considered a far dream. This cleanup has led to a massive profitability lift for the PSBs. Return on assets for many PSBs is now approaching 1.1%, which was once considered a far dream. While the performance is dramatically improved from the near zero or negative results of the past, private banks still lead, generally clocking ROA in the 1.7 to 1.8% range. Now, the net interest margin gap, now that's the spread a bank earns on assets after funding costs, is basically the share the bank keeps after paying for deposits or borrowing, and the income earned from leading or investing activity has also narrowed, with the PSB average NIM reaching 3% in FY25, though this remains lower than the typical 4.1% reported by private banks. Now, despite this convergence, private banks still maintain a clear lead in certain high growth and high margin areas, specifically digital adoption and fee income. Public sector banks accounted for only about 17% of UPI digital payment volumes in 2024, while private banks dominated, handling 82% of that volume. Now, further, you even have private banks benefiting from significant fee income streams like advisory, distribution, and cards that are derived from their technologically integrated customer base. PSBs are, trying to actively catch up by investing in digital initiatives like you have SBI's YONO app and monetizing their large customer bases. But this gap in digital penetration and free diversification, it still persists. Now, to put it very simply, PSBs have rebuilt themselves, but they still trail private banks on profitability and digital depth. The next question that would come about is, can further consolidation close those gaps faster? Well, following a pause since 2020, the consolidation of public sector banks has returned to the forefront of the policy agenda. Now, the government sees this moment as opportune because you have PSBs have enjoyed 2 to 3 years of solid performance, making it politically easier to merge profitable and well-capitalized institutions. The core aims of the new consolidation blueprint: scale, efficiency, technology, and supervision. Now, officials quoted in reports stressed that the goal is to optimize overlaps and extract synergies in operations, technology, and procurement. Now, the overriding objective is the creation of mega banks with robust balance sheets that are truly world-class. Now, this fresh blueprint, according to report, envisions specific pairings, though not officially confirmed by the banks. Now, the most prominent and flagship pairing currently mooted is the merger of Union Bank of India with the Bank of India, and both of which are Mumbai-based public sector banks. Now, this pairing, it makes strategic sense because the merger would create an entity of roughly 25.7 trillion rupees in assets, instantly making it India's second larger PSB, and that would surpass Bank of Baroda. Another specific merger rumored is between Indian Bank and Indian Overseas Bank, both Chennai-based, and that's aiming to unlock operational synergies and create a stronger regional powerhouse in the southern markets. In parallel with these mega mergers, selective privatization is being considered as a separate track. Now, the government's plan includes flagging two of the smallest PSBs, Punjab and Sindh Bank and Bank of Maharashtra, as candidates for strategic sale to private investors in later phases. Now, this strategy ensures that these institutions, which are limited by their small scale, could benefit from fresh capital and private management. A move potentially even more consequential for investors than the mergers themselves. The government is considering a policy change to address the disparity in foreign investment access. Now, foreign ownership in PSBs is currently strictly capped at 20% of equity. This contrasts sharply with private banks, which permit up to 74% foreign ownership. Now, the proposal is being discussed between the Finance Ministry and the RBI, and this is to raise the foreign direct investment cap in PSBs to 49%, with the government guaranteeing that it would retain a minimum 51% majority stake. This policy change is aimed at leveling the playing field for state-owned banks. If implemented, this reform would significantly change capital flows and dynamics. Firstly, a higher cap would broaden the investor base, as foreign institutions currently hold only single-digit percentages in many public sector banks. Secondly, it would increase PSB's free float, which is expected to cause global index providers such as MSCI to raise their inclusion weights for these stocks. This index rebalancing would force passive tracking funds to buy PSB shares. As a result, analysts estimate that this policy change could unlock about $3 to $4 billion of passive inflows. State Bank of India alone is projected to attract around $2.2 billion of these passive inflows. And beyond the immediate inflows, increasing the FDI limit is expected to lower the cost of equity over time for public sector banks. And that's not all. India's public capex is running at a record level of 11.21 lakh crore rupees, and early execution in roads and rail, where ministries have already deployed over 3.1 lakh crore by September. This scale and pace of spending puts PSU banks, well, thanks to their nationwide networks and deep ties to government projects, this puts them in prime position to capture the next leg of credit and P growth as orders move into executions. On top of that, the RBI's new infrastructure lending framework, which puts provisions on under construction project loans from 5% to 1%, should further improve bank willingness to fund capex, lowering the friction for large project finance. Well, regardless, the FDI proposal was met with immediate market enthusiasm, causing the Nifty PSU Bank Index to a high of 8,053 on 27th October 2025, the day the news broke. And that surge set a stage for a quick reality check on value. Even after the FDI-driven pop, PSU banks still trade at a clear discount to private peers. Now, as of October 2025, the Nifty PSU Bank Index sits around a price-to-book ratio of 1.33 and a price-to-equity of 8.4 with a dividend yield of 2.3%, versus the Nifty Private Bank Index at a price-to-book of 2.16, price-to-equity of 19.8 and a yield of 0.5%. This is a sizable gap that hasn't closed despite a strong re-rating since 2020. For investors, the message is straightforward. On today's multiples, PSU Bank looks cheaper than private banks that command a premium for franchise quality and consistency. But remember the risk as well. In particular, execution risk in new mergers. Large integrations can misfire. Core banking migrations, HR harmonization, and merger accounting can cause service disruption, slower synergy capture, or reveal hidden losses if one partner's book is weaker. And while a potential PSB merger is being discussed for around 2027, nothing is confirmed. There's no official notification yet, so timelines, pairings, and terms, they are entirely uncertain as of now. Now, given this current valuation discount and the risks, would you still allocate to PSU banks here, or stick to private banks for quality and build a barbell of both? Share your thoughts in the comments below, and thank you for watching this edition of Bottom Line by Groww.